We just spoke there about the moves that we've seen in treasury markets, but generally when you can get 5% on a T-bill risk-free at the moment, what does that tell you about the outlook for equities?
Well, overall, it tells you not particularly attractive. And it's a confusing picture in some ways because we, as a house, have been pretty optimistic about the global economic outlook, long expecting the US to avoid recession. We don't have recessions now forecast even in Europe, which was really at the epicenter of the risks last year with rising gas prices. But I would say two things. First of all, equity markets are really pricing that outcome now. We don't think they're pricing a recession. And secondly, as you say, you're getting quite a high return in competing assets with much less risk. So overall, the biggest market in the world, we're looking at a flat return. We've been preferring non-US markets for quite some time. We still do. But even there, the absolute returns we think are going to be relatively modest overall at the index level this year.
So modest returns overall, where are you then looking to get the most alpha?
Well, I would say two things. Firstly, if you take all of the regions globally, we've got the highest return forecast in Asia. It's partly a valuation story and a recovery, the opening up of China. And secondly, I think you really need to look within and beneath the equity index level to really find better relative opportunities. Now, that's been the story already for much of the last year, where we found for the first time in more than a decade, valuation really mattered. Cheaper things outperformed. In the previous decade, generally more expensive things were outperforming, and we think that will continue. So we like pockets of value. In Europe, where I cover in particular, we've had a strong preference for banks, which have been a disastrous performing area for more than a decade, and over the last year have performed well. We think there's more to go there. We like energy and commodity related sectors as well, and we sort of balance that with a preference for stable margin businesses across industries, and that's true globally.
When you talk about Europe outperforming the US, what exactly do you see driving that?
I would say it's a couple of things. First of all, valuation. The US equity market remains quite expensive, trading at over 18 times. That's quite a bit above its longer run average. Most other equity markets trade below their longer run averages, and that's true in Europe as well. The most extreme cases in the UK, which has been our preferred European market, was the best performing major index last year. We still think there's a lot of upside. That's partly because it's very cheap, and partly also because it's got more exposure to the things that no one really wanted in the last decade, which was very dominated by large cap tech. But it does have a lot of exposure to these things that are finally seeing quite strong fundamental earnings growth. Banks, healthcare, resources and so on.
That split between value versus growth, but talk specifically, because is it really right to look at it in those terms, or how should people be really approaching value as a sector?
I think it's a good question, because there's a sort of tendency to look at everything in a very binary way, and that's the approach that many people have taken really since the financial crisis, because there was such an extreme difference between the growth factor and the value factor. And as that's reversed, it's almost as if people believe that you could see the same secular trends in the opposite direction. I think it's going to be more eclectic. We do like areas of value because we think as interest rate expectations probably continue to rise, or at least people start to question how long rates are going to stay at these higher levels, that will tend to benefit value areas of the market, but mean that cheap things have less to fall if there is a correction. But we like to balance that against pockets of growth that we don't think are that expensive, and where you've got more stable margins. That's what really the market is paying for. So things like healthcare would fit into that. Many of the staples as well. If you look at Europe, the biggest companies, the 11 biggest that we call the granolas, have become very large in the index, 25% of the 600 biggest companies, in a similar way that the big tech stocks became very large in the US. The difference, though, is that these super large European companies are still seeing stable and high margins, and that's maintaining their attraction as relatively defensive growth areas of the market. I would look at those as well.